Good afternoon, everybody. Thank you guys for joining me on this beautiful Friday. Today, we're going to be talking about a topic that is pretty creative, and that is how we're going to buy a home without the help of banks. Typically, this is referred to as what is called owner financing or seller financing. And there is another way that I'll get into after seller financing, which is called subject to. Subject to is another form of creative financing. But for now, with seller financing, to give you guys the simplicity of what it is a way that a seller practically creates the loan for a prospective buyer. You may be thinking, well, why would a seller want to do that? There are a lot of pros and cons to this situation, but the biggest longevity of things is that a seller can really liquidate as much money as possible when it comes to seller financing compared to doing the traditional manner, right? And that's the simplest way to put what it is. And to jump into why a seller would want to do this, or why a buyer would want to do this, think about it in a way of, in the buyer's shoes. Let's say you have all the income that is needed to get a loan, but you got some judgments or some repos or some past due child support that now you have to get your credit situated, right? And you can't just go and get a good loan with the income that you have now due to the credit issues that you have, right? So a good way to go around these issues with the banks is that you go ahead and get directly with the seller or with an agent. It all comes down to how much every situation, because some agents just don't have or understand the full process of what seller financing is. And that's a very key thing on who you choose to work with, to know not just the new, but as well as the old. And this is something that has been used as much as, I don't know how long. I mean, it's like an ancient form, truly. With that, I would definitely like to go into the seller's perspective now as to why they would want to use this seller finance opportunity. And that is more in the longevity of things when it comes to how much money they make. Think about it as a buyer, or the bank. The banks, they make all the money when it comes to the interest payments, and the seller only makes the principal, right? That's traditional. With seller finance, the seller is not only making the principal, but the interest on top of the principal that the bank would usually be receiving. With that, in a traditional transaction, it typically takes about 9 to 10% to actually sell your home with the realtor. No negativity towards realtors, but and that's not, necessarily bad. It's just you're not making that money that you have it listed for on the market. So let's say you originally have it listed for $300,000, right? And you list it with an agent. You're realistically probably keeping only $250, $260, maybe $275 if your realtor had some good negotiation skills. With that, that's not even including the taxes for any capital gains that you actually hold or win get out of the property, right? That's a very minimal example, but when bigger numbers get into it, you have to pay capital gains tax. You have to just deal with all the bank situations that, appraisals, home inspections, all that stuff. And then paying for all the services of a title company and a realtor, right? So instead of going through all that mumbo jumbo, you get directly with a good buyer. Obviously, you want to, as a seller, really qualify them yourself. You really want to take charge within yourself to look at their whole profile on just their financials, right? To ensure that they're actually going to make things happen. Another beauty of this is that you actually can create your own contract as a seller or as a buyer. right? Really, the best way to go about it is to make sure that both sides have attorneys and the contract is, sufficient to both parties, right? There are a lot more things that go into it, but to keep this sweet and concise, I'm going to leave it right there for seller financing. Now I'm going to jump into what is called subject to. Keep in mind, both these opportunities or creative finance strategies are very ancient ways of buying real estate or acquiring real estate. Subject to put it in simple terms, is when an owner allows a buyer to take the deed of the property subject to the existing mortgage. So what that means is that the seller keeps their name on the loan, but transfers the title to the buyer, right? This situation is a little bit more particular, and you want to make sure that you're sitting down with somebody who has actually closed situations like these, right? Mainly because of the fact that there are a lot of things that go into doing this process with servicing the loan on the seller side as the buyer. You want to make sure that you take the necessary steps to make sure that it's taken care of. The seller's loan is being taken care of, right? So that's essentially what it is. You just kind of take over the loan, but without assuming, right? Because assumption of a loan, that's a whole different thing. That you actually went and sat down with the bank, and the bank knows that you are assigning yourself to their loan, right? Yes. Or is it assumption? It's one of the two, either assigning or assumption. I'm sorry, I won't. But regardless, subject to is really without the bank's knowledge, and it's completely legal to do. You just have to make sure that you take the right steps in servicing the seller's loan, right? And you take the proper steps with the title company as well when you take the proposal to title, because title's going to take care of all that. There are also ways to actually do a sub-2 and wrap it with the seller finance. So that way, the owner not only gets their debt paid off, but as well has making some profit after, let's say they have 95% equity on the home, right? So they can wrap it with seller finance for after that 5% that's remaining for the balance of the original loan or original lien. That's what it is now. Why would you want to do subject to? Those are very specific situations when it comes to how you really find these sellers. A lot of them are kind of like in pre-foreclosure or in situations where they bought a home and they have no equity and they just need to get rid of it. For those who are poking holes in how to, for the seller, you can actually get what is called a DTI declaration and to take to your next bank. Like, let's say you are the seller, but you want to go and buy another house with another loan. You ensure that you have credentials proving that the buyer is servicing your loan, and you can use that as a DTI declaration to take to the next bank that you want to go and get a loan with to purchase the next home, right? Because they're going to look at that and be like, what's going on here, right? And with that, you can hand it over to the buyer and not have to worry about the home. As long as, that's the thing though, guys, at the end of the day, you want to make sure that you are doing your due diligence. You can't just do this with anybody, right? You have to make sure that these people are going to pay your bills or pay whatever is needed. And or if you want to make sure, if you feel as if there is another opportunity in stating something in the contract to where if something goes wrong with the buyer, you get the house back. Although a lot of times when people do this, they don't want to get the house back, and that's a big deal for them. But for sellers who have 100% equity in their property, it's a good opportunity in the sense of, you're making all this money, and if you have a chance to get the property back, then you just get the property back and do it all over again. Hopefully if the buyer doesn't destroy the property. But anyways, there's a lot of ways that this can go left or right. But the moral of the story is you want to make sure that if you are going to proceed with one of these actions, you sit down and do your due diligence with an agent who is experienced and knows how to close these transactions. Yeah, that's all I got for that right now. I don't know if we have any questions.
Yes, we do have a question. When sellers check the credit scores of buyers, is that like an important point when trying to buy a house without getting a traditional loan through a bank?
Yeah, I mean, as being a seller, you want to make sure you do due diligence. You really want to act like the bank. I mean, it's just a matter of making sure that you kind of take the necessary steps to protect yourself, or make sure that in the contract, you and your attorney set something up to kind of make sure that if the buyer defaults, you get the property back ASAP, and you are able to, just do whatever. I mean, if you, as a seller, if you get the property back and you have the funds or the reserves to handle whatever the buyer left you with, then you essentially made all that money. And, well, I mean, it all depends. It all depends. But if you go left or right.
Okay, we don't have any more questions.
Well, I appreciate you guys for coming by today. I wish you guys nothing but the best, and we'll be in touch. Please reach out to me if you ever want to have some more information or conversations about seller financing or subject to. My phone number is 512-590-0740, and my Instagram handle is Daniel, but instead of an L, it's a 1 and then GG. Right. Thank you guys for coming by. You guys take care. God bless you.